A new trader enters the market full of hope. He's been studying charts for months. He knows his indicators. He journals every trade. He follows strict risk management. And finally, he takes what he thinks is the perfect setup: confluence of support, clean breakout, tight stop, solid reward to risk. He executes with confidence. 7 minutes later, he's stopped out. Price reverses, right after taking his stop, and then shoots in the exact direction he predicted. It happens again, and again, until the confusion becomes anger, until the self-doubt begins whispering, maybe I'm just not cut out for this. But what if the problem isn't you? What if you're not actually trading at all? What if you're unknowingly being played in a game you don't even know exists? Welcome to the invisible arena, where every tick, every trap, every candle is part of a psychological war, a game without rules. A game where your decisions are just reactions, and your confidence is the weapon used against you. In this arena, you are not alone. You're surrounded by players you'll never meet, strategies you'll never see, and forces that manipulate your every move while you think you're in control. But here's the twist. This arena has a hidden logic, a deeper code, a set of invisible rules that, once seen, cannot be unseen. And if you learn them, you don't just survive, you win. Welcome to Trading Psychology Stick, where we decode the mental game behind every market move. What you're about to hear isn't financial advice. It's the psychology of power, deception, and strategic thinking applied to trading. Quick reality check. This isn't about getting rich quick. Studies show 90% of traders lose money, not because they lack information, but because they misunderstand the game. What you're about to learn won't make you profitable tomorrow, but it will show you why you've been losing and how to think differently. The transformation takes time. Most traders need 6 to 12 months to internalize these concepts. But the journey starts with awareness. This video isn't another top 3 trading mistakes or RSI strategy for beginners. This is your reprogramming, because underneath the surface of every impulsive click, every fake breakout, every revenge trade, lies a game theory that controls them all. By the end of this video, you'll know how the invisible players think, how they set traps, when they cooperate, and when they betray. And most importantly, you'll know your next move before they make theirs. Once you see how the game is really played, you will never trade the same again. Chapter 1, The Invisible Arena. Every time you open your trading platform, you step onto a battlefield. But here's the catch. You can't see your opponents, the rules aren't written anywhere, and the scoreboard lies. You think you're making logical decisions based on technical setups and clean entries. But the truth is, you're reacting to a choreographed illusion, one designed to manipulate your next move. You are inside what we call the invisible arena. Imagine this, a dark arena with thousands of other traders. None of you can see each other. Everyone's making moves. Some act fast, others wait in the shadows. You're reacting to lights and noise, not realizing that someone else is controlling when those lights flash. That's the market. It's not a fair contest. It's a game, one that punishes the unaware and rewards the strategic. The market doesn't care about your win rate. It doesn't care about your emotions. It only cares about liquidity, and retail traders like you are the perfect fuel. You're the one providing the exit for institutional positions. Your stop loss, that's their entry. Your hesitation, their opportunity. And the worst part, most traders don't even know they're in a game. They think they're analyzing charts, but really they're being analyzed. Their habits, timing, reactions, measured, modeled, and used for profit. Let me tell you about Jaden. He's a smart guy, graduated in economics, read every book on technical analysis, built an algorithm that back-tested beautifully. But when he went live, everything fell apart. Patterns failed. Price ignored his zones. He blamed himself. Until one day, after another stop out, he looked at the liquidation chart and saw hundreds of traders stopped at the exact same level. That's when it hit him. He wasn't trading a pattern. He was part of someone else's strategy. The invisible arena is not about who has the best strategy. It's about who understands the game being played around them. Research from behavioral finance shows that institutional traders profit not from being smarter, but from understanding crowd psychology. They know where you'll place your stops. They know when you'll panic. They've studied the patterns of human emotion, and they trade against them. And once you start to see it, everything shifts. You begin to question price action that once looked clean. You start noticing how fake breakouts always seem to happen right after retail piles in. You see volume spikes that trap breakout buyers. You realize that every move you've ever thought was your idea might have been implanted by someone else. What the architect of this invisible game really wants is your reaction, your fear, your hope, because that's predictable, and predictability is profitable for them. Have you ever placed a trade, then immediately felt the market was watching you, as if the moment you clicked buy, the candles turned against you? That wasn't coincidence. That was design. You're not crazy. You're just late to realizing you've always been inside the arena. Here's your first tactical adjustment. Before any trade, ask yourself, who benefits if I enter here? Whose exit am I becoming? This simple question will save you from 50% of bad entries. But this is just the beginning, because if the market is a game, then how do players win? How do they cooperate or deceive? And why do even the strongest alliances eventually fall apart? To answer that, you'll need to step into the first unwritten rule of this psychological battlefield. No one actually wants you to win. Chapter 2. No one wants you to win. It sounds harsh, doesn't it? No one wants you to win, not the market, not your broker, not even your fellow traders. But let's be honest, when was the last time someone genuinely celebrated your success in trading? In this invisible arena, cooperation is temporary, and loyalty has an expiration date, because here, everyone's playing for themselves. And the game, it's wired for betrayal. Let's begin with a story. Two hedge funds form an alliance behind closed doors. Their goal? To drive up the price of a low liquidity token, ride the momentum, and exit with millions. Phase 1. Coordinated buys. The chart spikes. Retail notices. Influencers start tweeting. Phase 2. Liquidity floods in. Phase 3. One of the funds pulls out first, secretly, silently. The other is left holding the bag, along with thousands of retail traders who thought they were riding a breakout. The price crashes. Panic selling begins. The alliance was never real. It was just a temporary illusion of trust, a shared strategy that lasted only until self-interest dictated otherwise. This isn't fiction. It's the prisoner's dilemma, played out in real time. In game theory, the prisoner's dilemma shows that even when two parties can benefit by cooperating, they often end up betraying each other to protect themselves. Why? Because the fear of being the one left behind is stronger than the desire to win together. Princeton game theory research confirms. In repeated games with finite endpoints, betrayal becomes mathematically optimal near the end. The market knows this. That's why breakouts fail just when everyone's convinced. That's why support breaks right after the crowd defends it. Sound familiar? How many times have you followed a popular trading group's signal, only to see price reverse the moment you entered? How many alpha calls on Twitter felt like traps in disguise? You weren't being paranoid. You were being harvested for exit liquidity. In the invisible arena, trust is a mirage. Even when you think you're aligned with others, friends, groups, influencers, you're still just a player in their game. Their goal isn't your win, it's their exit. And that means your entry becomes their opportunity. Your confidence becomes their signal to leave. Here's what the architect of this game knows. People crave belonging. They want community, consensus, shared moves. But in markets, that longing becomes vulnerability. Because when you follow the herd, you give up your edge. You surrender your timing. You give others control over your outcome. Have you ever joined a signal group and entered late, only to find yourself underwater while the leaders brag about their profits? That's not an accident. That's design. You weren't invited to win. You were invited to fund the win. Now ask yourself, if betrayal is inevitable, what kind of trader do you need to become? You don't need to isolate. You need to think independently within the crowd. Watch what others do, but never follow blindly. Use their predictability against them. Here's your tactical evolution. Create two watch lists, what everyone's watching and what no one's watching. Trade the second list. Let the crowd provide liquidity for your exits, not your entries. Because in this arena, the winners don't seek trust, they seek clarity. They don't move with the herd. They move after the herd reveals its position. But to do that effectively, you need to master the art of being unpredictable. Not random, but strategically dynamic. Let me show you how. Chapter 3. Predictably unpredictable. In war, if the enemy knows your next move, you're already dead. In poker, If your patterns are obvious, you're just a bankroll waiting to be drained. And in trading, if the market can anticipate what you'll do next, it will punish you for being too consistent. You see, humans crave patterns. We love certainty. But markets, they devour predictability. Because every time you repeat yourself, same setup, same time, same reaction, you become easier to trap. This is why top traders, from Wall Street to crypto Twitter, sometimes seem erratic. They pass on perfect trades. They trade weird hours. They go silent after wins. And when they do act, it feels like they're improvising. But it's not chaos. It's strategy. They are using one of the most misunderstood weapons in the entire invisible arena: strategic unpredictability within systematic rules. Let's be clear, this is not about random trading. That's the fastest way to blow up. This is about being predictable to yourself while being unreadable to the market. In game theory, a mixed strategy means you intentionally vary your actions within a framework to stay unpredictable. Think of a jazz musician. They know the scales perfectly, but never play the same solo twice. The structure is consistent. The expression is dynamic. Your trading system is the scales. Your execution is the solo. Enter Max, a mid-level trader who kept getting stopped out. He had a strong edge, a 3-candle pattern near support. It worked, until it didn't. Over time, his win rate tanked. Why? Because the more he repeated the edge, the more visible it became. Algorithms adapted. His pattern became the entry trigger for others to take the opposite side. So, he evolved. Instead of always taking that same pattern, Max created variations within his system. Sometimes he entered on the second candle if volume spiked. Sometimes he waited for the fourth touch if too many eyes were watching. Sometimes he skipped the setup entirely on purpose to break his behavioral pattern. His rules stayed the same. His execution became dynamic. And guess what? His win rate didn't just return, it exploded. Not because he found a better edge, but because he stopped being easy to read. You might be wondering, but isn't that inconsistent? Isn't that undisciplined? Not at all. Here's what the pros know. Discipline isn't doing the same thing every time. Discipline is having a system flexible enough to be unpredictable. Let's get practical. Here's your strategic unpredictability framework. Time variation. If your setup appears at 9:30 a.m., create 3 responses. 40% of the time, trade immediately. 30% of the time, wait 15 minutes for confirmation. 30% of the time, intentionally skip it and wait for the afternoon setup. Same edge, unpredictable timing. Market rotation. Week 1, focus on EUR/USD. Week 3, switch to GBP/USD. Week 4, indices. Same strategy, different playground. Algorithms tracking your EUR/USD pattern lose your scent. Strategic absence. Keep a phantom trade log. Document setups you skip on purpose. Not from fear, but from strategy. Today I'm invisible. This breaks your pattern without breaking your rules. Size variation. Within risk, always risk 1 to 2%, but vary how. Trade 1, 1% risk with tight stop. Trade 2, 1% risk with wide stop, smaller size. Trade 3, 2% risk on A+ setup. Same risk management, unpredictable position sizes. Have you ever felt nervous because your setup looked different? Good. That's where evolution begins. That's where you stop trading patterns and start trading behavior. Because in the invisible arena, the moment they can read you, they can delete you. The market can't exploit what it can't pattern, and you can't be patterned if you're strategically dynamic within your system. But being unpredictable is just defense. What if you could go on offense? What if you could use deception as a weapon? Let me show you the art of the trading bluff. Chapter 4. The Bluffing Game. The most profitable moves in trading aren't always the ones that happen. They're the ones that almost happen. The fake breakout. The clean setup that never confirms. The candle that screams momentum, only to reverse and erase everything. These are not glitches. They're not bad luck. They are intentional illusions crafted to provoke, manipulate, and exploit. Welcome to the bluffing game. If you think bluffing is just for poker, think again. In the invisible arena, bluffing is a psychological tool used to shift the balance of behavior. It's not about lying. It's about crafting a version of the truth that your opponent reacts to before realizing they've been baited. Let me paint the picture. A big red candle breaks through a key support level. Volume spikes. Panic hits. Thousands of retail traders short the move, thinking it's a breakdown. But what they don't see is the hidden liquidity pool just below, the one the institutions need to tap. And when price reaches it, the entire move reverses violently upward, taking out the shorts one by one. That wasn't a failed setup. That was a setup that was never real to begin with. Here's the truth. Many large players don't need to win after you act. They win by getting you to act first, then flipping the narrative. That's bluffing. It works because human brains are wired for confirmation bias. You see the setup you want to see. You interpret candles based on what you hope will happen. Smart money knows this, so they manufacture just enough evidence to nudge you into conviction, and then pull the rug. Let's talk about Zoe. Zoe was a price action purist. No indicators, just clean levels and volume. She prided herself on reading the market raw, but her edge began failing. Clean breaks faked out. Volume confirmed moves. That never materialized. It wasn't that her system stopped working. It was that the market evolved. Once enough people trade the same level, it ceases to be a level. It becomes a trap. So Zoe shifted. She began asking not just, what does the chart say, but who benefits if I take this trade now? She started studying who the move would bait, who it would punish, and what incentive lies beneath the price action. She no longer reacted to the bluff. She read it. And once she could read it, she could fade it. Here's your bluff detection protocol, the too perfect setup. When a setup looks textbook perfect, ask why. Perfect setups are often bait. Real opportunity usually comes with some imperfection. The volume tell. Big volume on a break, check where it came from. Institutional volume builds gradually. Retail volume spikes suddenly. Spike volume often marks the end, not the beginning. The social media test. If everyone's tweeting about a level, it's already compromised. The best levels are quiet levels. Because here's the secret most traders never hear. You can bluff the market too. By holding your bias through noise. By not chasing when everyone else does. By placing orders where it hurts the most, not where it feels safest. By showing strength when you're taking profits, and showing nothing when you're accumulating. Have you ever skipped a trade because it felt too obvious, and then it failed anyway? That wasn't intuition. That was subconscious bluff detection. So, train it. Develop your bluff radar. Start a journal specifically for too good to be true setups. Track what happens. You'll be shocked how often the obvious move is the wrong move. Bluffing in the market is about appearing predictable while being deeply unreadable. It's the bullish engulfing pattern. That was designed to trap bulls. It's the RSI oversold during a distribution phase. It's the perfect setup, at the perfect place, designed to destroy your confidence. And the market will keep bluffing you until you learn to see through it. Because once you can detect deception, once you understand the game of false signals, you're ready for the next level, mastering the power of patience. Let's talk about why the best traders often do nothing, and why timing beats talent every time. Chapter 5. Timing beats talent. Imagine two traders staring at the same chart. One has 10 years of experience, custom indicators, institutional insight. The other is newer, less data, less edge. But the second trader waits, watches, times the entry with eerie precision. After the trap is sprung, after the fake breakout, after the panic. He enters while the first trader is still managing chaos. Who wins? Not the smarter one, not the faster one, the one with better timing. In the invisible arena, timing isn't everything. It's the only thing. Because this isn't a game of raw skill. It's a game of psychological initiative. Who reveals first, and who exploits that reveal. There are two types of moves in trading, simultaneous and sequential. Simultaneous moves are like flipping a coin. Everyone acts without knowing what others are doing. It's random, it's reactive. Most retail trades fall here, entering on impulse, guessing direction, hoping for confirmation. Sequential moves, though, that's where the killers live. A sequential move means you let others act first, so you can strike with clarity. It's the second player who wins the chess game, not because they react, but because they wait long enough to see the future unfold. Enter Julian. Julian was addicted to being first into a breakout, first to call a top, first to catch the reversal. It made him feel smart until he noticed a pattern. His best trades were always the ones where he waited, the ones where he watched volume mature, liquidity shift, sentiment peak. One day, he changed everything. No more trying to be first. His rule became, wait for the overreaction, then enter the echo. He created what he called the second wave protocol. Wave 1. The obvious move happens. Breakout, breakdown, news spike, whatever. Let it happen without you. The pause, price stalls, volume drops, confusion sets in. This is where 90% of retail traders are positioned. Wave 2. The real move begins. After the weak hands are shaken, after the obvious traders are trapped. This is your entry, and the difference was night and day. Because price doesn't reward those who rush, it punishes them. It rewards those who understand the rhythm of unfolding. Have you ever been early on a good idea and still lost? Have you ever caught the right level, but too soon? That's not bad luck. That's initiative imbalance. In game theory, being the first to move gives you control, but also vulnerability. You commit before others show their hands. That's powerful in some cases, but deadly in others. So, how do you know when to move first, and when to let the game come to you? Here's your timing decision tree. Move first. When you have information asymmetry, news others don't know. The setup is uncrowded, no one's watching. You're scaling in, not going all in. Move second. When everyone's watching the same level, social media is hyped, the setup is too perfect, volume is already spiking. Market makers know this. They bait you to move early, into fear, into FOMO, into false momentum. But if you train yourself to see their move as the opening act, not the climax, you get to write the ending. You're a second mover timer. When you spot a setup, log the exact time. Set a 15-minute timer. Don't act until it expires. In that window, watch who enters, where stops cluster, how price responds. 80% of the time, the picture changes completely. Like the swordsman who draws only after the enemy attacks. Like the hunter who waits until the prey forgets they're being watched. Like the trader who skips the candle and enters the aftermath. Because sometimes, the deadliest blow is the one thrown last. And when you master timing, you begin to see a new pattern. It's not about where price goes, it's about who flinches first. And when you no longer flinch, you become the one setting the tempo. But patience is just one part of the equation. What about commitment? What happens when you need to hold through the noise? Let me show you the power of burning your boats. Chapter 6. Burn the boat. The power of having less to lose. There's a story from ancient war. A general sails across the sea with his army to face a brutal enemy. When they arrive, his men begin setting up camp. But instead of preparing a retreat plan, the general orders them to burn the boats they arrived in. The message is simple. We win, or we die. That story isn't about war. It's about the intersection of commitment and freedom. And in the invisible arena of trading, this paradox is everything. You see, most traders fail not because their strategy is wrong, but because they're negotiating with two enemies, the market and themselves. They leave mental back doors open. They trade with one foot out the door. They risk more than they can emotionally afford to lose. But here's the paradox. The traders who risk less often win more, not because they're conservative, but because they're free. Let me show you what real commitment looks like. Ravi had a habit of pulling his stop loss. He'd place it, swear not to touch it, but when price came close, he'd adjust. The loss would balloon. His problem wasn't technical, it was psychological. He was trading with money that meant too much. After blowing his third funded account, Ravi did something radical. He took his $10,000 account and moved $7,000 to savings. He decided to trade only the remaining $3,000. Not because he lacked capital, but because he needed emotional freedom. Then he created rituals. He physically removed the mouse from his desk after entry. He wrote his risk on paper. I choose to risk $30 on this trade. I accept all outcomes. He taped it to the screen. And suddenly, he became dangerous. His stops stayed put. His targets got hit. His psychology transformed. Not because he found the perfect edge, but because he lowered the emotional cost of being wrong. Game theory calls this credible commitment. When your opponent knows you can't back down, they must adjust to you. But here's the twist. In trading, you're often your own opponent. The market feeds on desperation. It can sense when you're trading with scared money, when you need the trade to work, when losing would hurt too much, and it exploits that fear mercilessly. This is why hedge funds use small position sizes relative to their capital, not because they're scared, but because they need psychological distance. They enter every trade with the posture, I don't need this to work, so I'll let it work. Here's your freedom formula. Step 1. Calculate your sleep easy size. What loss would you shrug off? That's your max risk per trade. Step 2. Cut that number by 40%. Yes, 40%. This is your actual trading size. Step 3. Double your targets to compensate. You're trading the same reward with emotional freedom. Step 4. Create physical commitment rituals. Write your plan, photo it. Make it real outside your mind. Have you ever held a winner longer just because the size was smaller? Have you ever managed a trade better when it didn't matter? That's the freedom paradox at work. So, here's your edge. Lower your downside until losing doesn't scare you. Trade a size that lets you act with indifference, not attachment. Because the trader who can lose without flinching wins without force. The market respects one thing above all, the trader who doesn't need it. When you burn the boat of desperation, you gain the ship of clarity. But commitment and freedom are just individual powers. What happens when thousands of traders unconsciously coordinate? What happens at the market's secret meeting points? Let me show you where the crowd gathers, and why you should wait outside. Chapter 7. The crowd's secret signal. There are places on every chart that feel magnetic. No news, no indicator, no Fibonacci line, and yet price keeps returning. Liquidity builds, emotions spike, orders cluster. It's as if the entire crowd silently agreed. This is the spot. But no one said it out loud. No Telegram alert, no influencer tweet, no smart money clue, just pure collective convergence. This phenomenon isn't magic. It's not coincidence. It's a game theory concept called the Schelling point, a location where people naturally align, even without communication, simply because it feels like the obvious place to meet. And in trading, Schelling points are where you get hunted. Let me show you. You're long, price is ranging, everyone's watching the same resistance, round number, psychological level, clean zone. As price pushes upward, breakout traders jump in, stops are below the swing low, all very textbook. But suddenly, price nukes downward. It doesn't just tag the swing low, it rips below it, triggers the stops, flushes liquidity. And then, like clockwork, it reverses. You feel cheated, but you weren't tricked. You were simply too predictable. You showed up at the meeting point and forgot you weren't alone. Research shows that 70% of retail stop losses cluster at the same obvious levels. Institutional traders know this. They've studied it. They hunt it. Schelling points in trading are zones of emotional convergence. The 200 EMA, everyone watches it. Previous day's high-low, obvious reference. Round numbers like 1.2 thousand, psychological magnets. Equal highs and equal lows, retail's favorite. Minus 23.6% Fibonacci, the shallow retracement. The market doesn't always react to these levels because they're magical. It reacts because you do. It's not support or resistance, it's consensus. And consensus can be harvested. Enter Sasha. She was obsessed with clean setups. The more obvious, the better. She traded high volume levels, daily structure, psychological numbers. It worked until her edge decayed. What she realized later was chilling. She had become the entry liquidity for better players. Her buys at breakout zones became their exit. Her stops became their entries. So she flipped the game with her trap detector protocol. Before entering at any obvious level, count 3 things. How many times has this level been tested? More tests equals more eyes. How clean is the setup? Too clean equals too crowded. How many traders are likely watching? Check social media mentions. If all 3 score high, you've found a Schelling point. Your play? Set orders 2 to 3% beyond the obvious level. Wait for the crowd to trigger first. Enter only after the first wave fails. Or better, fade the entire move. She stopped trading at consensus points. She started trading around them, watching the crowd rush in, then fading the aftermath, and it changed everything. Here's what most traders miss. The more obvious the level, the more likely it is to fail on the first touch. Why? Because smart money uses the crowd's convergence to engineer moves. They don't need to force price. They just need to let retail build up energy at the Schelling point, and then reverse it. Have you ever entered a trade right at the level everyone was watching, only to get whipped out in seconds? That wasn't you being wrong. That was you being early to the wrong meeting. So step back, zoom out, and see the crowd signal for what it really is. A siren song. Your new mantra? Where would I place my stop if I was average? Now, let me place it somewhere else. Because when thousands of traders instinctively align, the market doesn't reward them, it harvests them. But avoiding the crowd is just one skill. What about the information you consume? What if every headline, every analysis, every edge you think you have is actually being used against you? Let's explore the danger of knowing too much. Chapter 8. What you know hurts you. They say knowledge is power, but in the invisible arena, knowledge can be bait. The more you think you know, the more you're sure you're right. And the more sure you are, the easier you are to trap. In game theory, there's a brutal concept: games of incomplete information. That means you're not just playing a game. You're playing a game where the rules, players, and even the stakes are hidden. And worse, some of the information you think you have was planted there on purpose. Let's step into the fog. You read the news. CPI better than expected. Bullish, right? The market thinks so too. Futures spike. Social media explodes with optimism. You enter long, confident, then price crashes. Not a slow fade, a violent dump. Within minutes, your thesis is burned, your stop is hit, and you're left staring at a chart that makes 0 sense. But here's what happened. The market doesn't trade the news. It trades the reaction to the expectation of the news. And if everyone expected a beat and got it, it's no longer fuel, it's fulfillment. And fulfillment kills momentum. This is the problem with known information. The more widely known a piece of data is, the less valuable it becomes. Because markets are forward-looking, they price in anticipation, and then punish predictability. Studies in behavioral finance show that traders who consume the most news actually perform worse than those who ignore it. Why? Because news creates false confidence. It makes you think you know something, when really you're just part of the herd receiving the same signal. Let me tell you about Kareem. Kareem built an entire system around economic events. He tracked every FOMC, every NFP, every CPI. He thought he had cracked the code. But over time, he noticed something eerie. The more confident he became in his edge, the more often he lost. It wasn't that the data failed. It was that the market had moved on. It was reacting to second-order thinking, not the number itself, but how different the number was from what the market expected the market to expect. Eventually, Kareem realized the truth. He was being fed certainty to make him vulnerable. So, he created the information skepticism framework. First-order information, the raw data. CPI is 3.2%. Market impact, 0, already priced in. Second-order information, how it differs from expectations. Market impact, moderate, causes initial move. Third-order information, how traders are positioned for the data. Market impact, maximum, determines the real move. Most traders trade first order. Smart money trades third order. This extends beyond fundamentals. It infects technicals too. You see a breakout? Volume confirms. RSI looks great. Price pushes, then slams down. Again. Why? Because that chart pattern wasn't a signal. It was a mirror reflecting back your bias. And someone else was watching the watchers. Someone who needed you to think it was bullish. Someone who needed your liquidity. Someone who knew exactly what you knew. So how do you survive? You embrace information skepticism. You stop asking, is this true? And start asking, who benefits if I believe this? How many others are seeing the same thing? What would I do if I knew the opposite? You stop trading headlines. You start trading reactions to reactions. You let go of needing to know, so you can stay nimble enough to adapt. Your new protocol. For every piece of bullish information, write down 3 ways it could be bearish. For every sure thing, identify 3 ways it could fail. Not to become paralyzed, but to stay flexible. Because in this arena, it's not what you know that matters. It's how quickly you can let go of what's no longer true. Have you ever clung to a trade because the chart should bounce? Have you ever entered because the news had to be bullish? Then you weren't trading price. You were trading your illusion of control. The market is not a teacher. It's a mirror. It reflects your overconfidence until you learn to stay fluid. Knowledge isn't power in trading. Adaptability is. And once you master the art of strategic ignorance, you're ready for the ultimate technique, the one that waits for everyone else to reveal their hand. Let me show you why the strongest traders often move last. Chapter 9. The power of moving second. In most games, the first move feels like the advantage. You strike first, you set the tone, You claim the initiative. But in the invisible arena, moving first is often a trap. Because the first move reveals your hand, the second move, that's the one that punishes it. This is the power of moving second, a principle so overlooked, yet so devastating when mastered. Let me show you exactly how this works. A breakout happens. Clean structure, strong volume, traders pile in, socials light up. We're going to the moon. You hesitate watching. You don't enter, not yet. Then price hesitates too. It stalls, no follow-through. And then the reversal begins. All that confirmation. It was just bait. And your refusal to move first, that's what saved you. This is where second movers live, in the shadows, in the aftermath, in the space where overexposure becomes opportunity. It's like chess. The first player opens with structure, but also vulnerability. The second player studies the rhythm, reacts surgically, and often controls the mid-game. Let me introduce you to the shadow protocol that changed everything for Mikkel. He used to be the first-in trader, loved the thrill, the breakout sniper. But his win rate was erratic, because for every clean break, there were 3 traps. Then he developed his system, the Shadow Protocol. Step 1, create 2 watch lists, crowd favorites, stocks trending on social media, obvious setups everyone's watching. After the storm, failed moves from the crowd favorites list. Step 2, the 48-hour rule. Never trade crowd. Favorites immediately, wait for the obvious move to fail. Move failed setups too after the storm. Trade these 24-48 hours later when emotional traders have capitulated. Step 3, the second wave. Entry wave. 1, the obvious move. Skip it. The pause, confusion, ranging, volume death. Wave. 2, the real move. Enter here. And it worked brilliantly, because when you move second, you're not guessing. You're reacting to a predictable reaction. This is what market makers do. They don't start the move. They wait for you to commit, then flip it. Research from order flow analysis shows that 75% of breakouts fail on the first attempt. But the second attempt, success rate jumps to 68%. The difference? The weak hands are already out. You ever notice how the best entries are often just after the fakeout? Right after the failed breakout? Right after the liquidation wick? That's not coincidence. That's the second mover edge. Your implementation checklist, the 15-minute timer. When you spot a setup, set a timer. Don't act until it expires. Watch who enters, where they place stops, how price responds. The reaction map. Document not just price levels, but crowd reactions. Where did retail pile in? Where did they panic out? These zones become your future entries. The patience paradox. The harder it is to wait, the more valuable waiting becomes. If every bone in your body screams, enter now, that's exactly when to wait. It's patience with purpose. It's precision without prediction. And here's the deeper layer. Second movers aren't weak. They're strategically invisible. They let the crowd scream. They let the fools flinch. They let the amateurs show their plan, and then step in and write the ending. Have you ever told yourself, I knew it was going to reverse. I just got in too early. That's the voice of a first mover in regret. Now imagine waiting, letting price come to you, not chasing, not guessing, just watching, and striking with zero doubt. That's how predators hunt. That's how second movers win. Because when everyone's trying to be first, the real edge belongs to the one who's willing to be last, on purpose. But what if you play perfectly? Second move, patient, precise, and the market still slaps you? Not because you were wrong, but because you expected something the market never promised. Let me show you the final truth that sets you free. Chapter 10. Fairness is a lie. You were early, you were patient, you were right, and the market still destroyed you. Why? Because you made the one mistake no strategy can fix. You expected fairness. It's the most dangerous belief a trader can carry. If I do everything right, I should be rewarded. But in the invisible arena, that's not how the game works. This game doesn't reward merit. It rewards execution under chaos. It rewards adaptability under injustice. It rewards those who stop needing it to be fair. Let's revisit a classic experiment, the ultimatum game. Two people are given $100. Person A decides how to split it. Person B can accept or reject. If B rejects the offer, neither gets anything. Now, logically, person B should accept any amount. After all, $1 is more than $0, but most people reject offers they perceive as unfair, even if it means losing everything. Because humans would rather sacrifice money than tolerate insult. Fairness isn't just a principle, it's an emotion, and in trading, it's a deadly one. You've felt it. The breakout failed, but it shouldn't have. The news was good, but price collapsed. You followed your plan, but still lost. And deep down, you whispered the fatal phrase, "That's not fair." But fairness was never promised. Not in this game. Not in any game driven by mass psychology, liquidity traps, and information asymmetry. Here's the truth. Markets are not designed to be fair. They are designed to be efficient at transferring money from the emotional to the strategic. And the moment you internalize that, you get free. Because the problem isn't that the market betrayed you. The problem is that you expected it to care. Enter Dana. She journaled obsessively, followed every rule, waited months for the perfect swing trade. When the stars finally aligned, she entered full confidence. The trade failed, not by logic but by noise. Some random news, some liquidity sweep, pure randomness. She was shattered, not by the loss, but by the violation of effort. She had done everything right, and yet, punished. It broke her, until she asked the question that changed her forever. What if the goal isn't to be treated fairly, but to keep trading well even when I'm not? That became her new edge, the unfairness protocol, daily affirmation. The market owes me nothing. I owe myself everything. Trade journal. Addition, for every loss, write one sentence. How did I execute? Not, was this fair? The 100 trade perspective. Judge yourself over 100 trades, not one. Randomness balances out. Execution compounds. Because resilience in trading isn't built on winning. It's built on not breaking when winning feels stolen. Here's what the invisible arena teaches us. Your best trades will lose sometimes. Your worst setups will sometimes win. And justice is an illusion the market sells you to keep you soft. But if you let go of fairness, you become dangerous. Because now, you're not emotionally attached to the outcome, only to the process. You're no longer shocked when good trades fail. You're no longer angry when randomness beats reason. You simply adjust and keep moving. And that kind of trader, they don't just survive, they outlast. So, ask yourself, have you been trading with justice in mind? Have you let losses feel like betrayal? Have you mistaken emotion for evidence? Then it's time to shed the belief that's been holding you hostage. Because once you stop expecting the market to be fair, you can start playing it for what it is. A chaotic system you must outmaneuver, not out-earn moral points from. The market isn't fair, but it is consistent in its unfairness, and that is an edge you can trade. And if you've made it this far, through the traps, through the timing, through the unfairness and the illusions, you're ready for the final shift. Not just in mindset, but in identity. It's time to stop being a player reacting to the arena, and start becoming the one who designs the game itself. Chapter 11. Your next move. You've seen the arena now. You've walked through the illusions, the traps, the betrayals. You've watched the game unfold, move by move, not as a fair competition, but as a psychological battlefield. You've learned how the pros think, how the crowd reacts, how the traps are set not with malice, but with precision. And now you're standing in the center of it all, with one question echoing in your mind: what's my next move? This isn't about strategy, not anymore. This is about identity. Because at this level, trading is no longer about entries and exits. It's about who you become when you're under pressure, when your edge breaks, when your plan gets tested, when the market whispers, let's see who you really are. So here's the final truth. You are not a trader. You are a strategist who happens to use charts. You are not here to chase moves. You are here to engineer outcomes. From this moment on, you stop looking for setups and start building systems that exploit behavior. You stop reacting to price and start responding to intention. The invisible arena will not change. It will always be brutal. It will always be unfair. It will always reward the patient, punish the predictable, and elevate those who can think 3 moves ahead. But now, you're one of them. Because you've seen behind the curtain, you now understand why moving second is stronger than going first, why randomness within rules becomes protection, why commitment with freedom is the true power, why the market doesn't punish mistakes, it punishes predictability, and most of all, you know how to see traps before they're even drawn. Not by guessing, but by reading the intentions of others, just like they used to read you. So, what's your next move? Here's your 30-day transformation protocol. Week 1. Awareness phase. Log every trade where you felt hunted. Study the pattern of your stops getting hit. Document your predictable behaviors. Week 2. Strategic absence. Skip 2. Obvious setups on purpose. Trade only. After the storm setups, practice being invisible. Week 3. Second mover. Training. No entries in first 15 minutes of any move. Use the shadow protocol exclusively. Document the difference in results. Week 4. Identity reset. Change one predictable behavior completely. Trade a market you never touch. Break your own patterns before others can. It's not another indicator. It's not another course. It's not the perfect setup. It's training yourself to act like the market's architect, not its victim. To zoom out, to slow down, to play chess while others play checkers. And when you re-enter the charts, you won't be looking for confirmation. You'll be looking for vulnerability, for patterns of emotion, for footprints of fear. And when you find them, you'll move with precision, not permission. Because your next move is to stop playing the market's game and start playing your own. Welcome to the other side of trading, the side where power isn't loud, it's silent, it's intentional, it's invisible, but it wins. Every time, become the player, not the piece. If you're still here, you're not the average trader. You're not here for signals, shortcuts, or surface-level motivation. You just walked through an 11-layer psychological map of the market, decoded through game theory, behavioral manipulation, and brutal emotional honesty. This isn't just theory. Princeton game theorists have proven these dynamics. Renaissance technologies built an empire on them. Paul Tudor Jones speaks about them. The concepts are real. The application is what separates the 90% who lose from the 10% who profit consistently. Let's recap the invisible arena's rules. You learned that? The market is an invisible arena where you're being analyzed while you analyze charts. No one wants you to win because betrayal is mathematically optimal in finite games. Being predictably unpredictable means strategic variation within systematic rules. The bluffing game is real, and the best setups are often traps in disguise. Timing beats talent because second movers see clarity in the aftermath. Having less to lose gives you more psychological freedom to win. The crowd's Schelling points are where consensus gets harvested. What you think you know is often planted information to make you vulnerable. Moving second isn't weakness, it's strategic positioning. Fairness is a lie, and the market rewards adaptation, not justice. And in the end, you don't need more tools. You need to become the strategist, the designer, the ghost in the arena. So, now it's your turn to move. Comment below. My invisible pattern was, but here's the depth. Don't just name a behavior. Tell me the emotion behind it, the fear that drives it, the specific moment you realize you're repeating it. Maybe it's, I move my stop loss when price gets within 5 pips because I can't handle seeing red numbers. Maybe it's, I enter breakouts immediately because I fear missing out more than I fear losing. Maybe it's, I revenge trade after any loss over $100 because I feel the market owes me. Whatever it is, name it with precision. Because awareness is how you break the loop. And if you're brave enough to expose your old identity in public, you're already halfway to rewriting it. This isn't just for engagement. It's your first act of strategic vulnerability. By stating your pattern publicly, you're burning that boat. You're committing to change. You're telling the market, I see you now, and I'm done being readable. After you comment, here's your immediate homework. Tonight, open your trading journal. Find the last 5 losses. Look for the pattern. Was it the same time of day? Same type of setup? Same emotional state? Write one paragraph about who benefits from your predictability. Tomorrow, do one thing differently. If you always trade the open, wait 30 minutes. If you always use market orders, use limits. If you always risk 1%, risk 0.5%. Break your pattern in a small, controlled way. This week, join our Invisible Arena community, where strategic thinkers share their shadow protocols, second mover plays, and pattern breaks. Not signals, not tips, but transformation through collective intelligence. And remember this one-liner, if nothing else from this video sticks. In a game of predators, power belongs to the one no one sees coming. Don't chase setups. Don't pray for fairness. Don't react like prey. Set your own trap, define your own timing, and play the market like it used to play you. Because now, You're not the piece, you're the player. And the game? It just got interesting. Welcome to the invisible arena. Welcome to strategic trading. Welcome to the other side. The market opens in a few hours. How will you play it differently? Your move.